DSCR loans have been around for years, but in 2026, the way they're being underwritten by lenders and the way they're being leveraged by investors is very different from previous years. We're going to take a look at this and also explain the basic fundamentals of how a DSCR loan works. The easiest way to understand a debt service coverage ratio loan is it's a business purpose loan. So that lenders are only underwriting the actual business itself, which is the property, right? So what kind of rental income is that property going to perform as a fully rented out rental property, right? So there's not going to be any questions about job verifications. They're not even going to check to see if you're actively employed. They're not going to ask for tax returns or verify any previous employment, unlike a conventional loan. So this is a great option, an alternative for investors who can't qualify off of debt to income ratio. Maybe they have a more complex financial situation with their income. Maybe they're capped out. Maybe they've already hit 10 properties and they can no longer qualify for conventional. So the lender, again, they're really mainly underwriting the actual property itself. So if you're buying a house, let's say that property is not rented, because most of the time you're not going to buy a property that already has current tenants in there. How the lender is going to determine the rental income, they're going to order a 1007 rent schedule. So an appraiser is going to build up this report. It's called a 1007. They're going to come up with a monthly figure of what that property would rent for as a fully rented out long-term rental property. Once that report comes back, the lender is going to take a look and then compare that to the monthly payment of the property you're buying. You're looking for a 1 DSCR ratio. This is the rent completely covering the mortgage payment after taxes, insurance, and HOA. With the mortgage brokerage platform that I work on a national basis, I'm seeing lenders are becoming a lot more forgiving for that DSCR ratio. In previous years, this would make or break the entire loan. In this day and age, lenders are really easing up with that ratio. More and more lenders are now giving approval with a 0.8 to a 1 DSCR ratio. Again, this means the rent doesn't quite cover that full mortgage payment after taxes and insurance. The main reason this is occurring is because DSCR loans are a pretty new loan product, really became popular over the past 2 to 3 years. Lenders are taking a look back at the performance of DSCR loans and seeing that they're performing on a really strong basis. So lenders are realizing that a lot of investors aren't buying that property just for the cash flow. They're buying for appreciation, tax benefits. There's a million reasons to buy a rental property. So lenders are becoming more forgiving for their guidelines. Therefore, that DSCR ratio is not quite as much make or break as it was just 2 or 3 years back. In regard to product and pricing, I know just a handful of years back, a debt service coverage ratio loan could be 0.5% higher in interest rate as opposed to conventional, even maybe 3/4 of interest rate. Now, because there's so much data on DSCR loans and that they perform very strong, the delta in pricing has shrunk, right? So a debt service coverage ratio loan might be pretty comparable to conventional, oftentimes just 1/4 of a rate higher, depending on the exact down payment and the credit score. So lenders are becoming a little bit more aggressive with how they price their loans. And there's going to be less margin stacked on because there's less risk. So we've seen pricing get a lot better for DSCR loans over the past year or so. In 2026, it's pretty much better than ever compared to recent years. In addition to that, lenders are more aggressive with how they lend for leverage, right? So previous years, you really need 20, 25% down for that lender to feel comfortable lending. Otherwise, there might not be any options at all. In this day and age, more and more lenders are now doing a 15% down DSCR loan, even on a 2 through 4 unit rental property. This is going to be huge for a lot of investors that they might not even realize this change has occurred, because it's going to be that much easier to scale now that you only have to put down 15% if you can find a property that has strong rental income. Again, not all properties are going to qualify for 15% down. You're going to need to have a strong DSCR ratio and at least a 1-to-1 ratio. Overall, in 2026, lenders have really eased up a lot with overall guidelines, a lot less stringent than just a few years back. Lenders are getting more aggressive with 15% down, and there's just overall less rules to comply with, less red tape. Lenders see that these loans are very strong loans and they're performing better than expected in previous years. So we've seen rates come down, guidelines have eased up, and it's never been easier to get approved. So any questions you have about DSCR, please drop me a comment. Again, my name is Austin Clarence. I'm your DSCR loan expert.